We're kicking off today with the story dominating macro desks this morning. President Trump has renewed his assault on Federal Reserve interest rate policy, publicly declaring that U.S. borrowing costs should be materially lower and alleging that political motivation is driving Fed officials. This is not background noise. It lands on a day when the VIX has spiked significantly to 15.35 and the 10-year Treasury yield sits at 4.65%. The bond market, the dollar, and growth equities are all moving in response. Let's break down exactly what is happening and who stands to win or lose. Trump's comments arrived this morning with markets already on edge. The 10-year Treasury yield is at 4.65%, down sharply today, while the 5-year yield sits at 4.35% and the 13-week T-bill holds at 3.70%. That near-term rate floor tells you the market is already pricing in some easing path. Yet Trump argues the gap between where rates are and where they should be is far too wide. Equities are reflecting genuine uncertainty about whether political pressure will translate into actual Fed action. This is a pressure campaign, not a policy announcement. Here is the deeper issue that most headlines are glossing over. The Federal Reserve's institutional independence is the bedrock assumption baked into Treasury pricing, credit spreads, and the dollar's reserve currency status. When a sitting or influential political figure publicly campaigns for rate cuts on partisan grounds, it introduces a credibility discount into that assumption. Markets do not just trade the policy outcome. They trade the probability that the institution will act predictably. Today's the VIX reading of 15.35 reflects that uncertainty premium expanding in real time. If credibility erodes even marginally, the entire yield curve can reprice faster than any single Fed meeting could correct. Let's name the tickers directly in the crosshairs. Long-term treasuries, the 20-plus year Treasury ETF, rallies if political pressure accelerates rate cut expectations, but gets hammered if the Fed digs in and yields spike back above 4.65%. The Nasdaq-100 represents growth stocks, which are the most duration-sensitive equity category, so any yield spike is a direct hit to Nasdaq multiples. The dollar index, tracked via DXY, sits at 98.77. Dollar weakness benefits gold. W&T offshore crude at 87.23 and Brent at higher levels are getting a separate commodity bid, but rate-driven dollar strength could cap those gains quickly. Here are the exact levels every macro trader should have on their screen right now. The 10-year yield at 4.65% is the pivot. A sustained break below 4.50% would signal that easing expectations are accelerating and would ignite a rally in long-term treasuries and long-duration equities. Watch the DXY at 98.77. A slip below 98.00 would accelerate commodity rallies in gold and oil. On the upside, dollar strength above 99.00 reverses that trade. For equities, the VIX closing above 16.00 would be a flight to quality signal worth respecting. The next hard catalyst is any formal FOMC communication. Until then, Trump's rhetoric is the loudest variable in the room, and it is generating more heat than light. The bottom line is this: Trump's renewed Fed criticism is political pressure, not policy, but that distinction blurs fast if it influences future FOMC behavior. The 10-year at 4.65% and the 5-year at 4.35% already embed modest easing expectations. Any credible signal that the Fed is capitulating to political pressure would spike volatility well beyond today's 15.35 the VIX reading and hammer growth equities in the Nasdaq-100 hardest. Conversely, a hawkish Fed hold would reverse the Treasury rally and pressure long-term treasuries. Stay positioned for that binary. Keep the 4.50% yield level as your line in the sand, and do not confuse presidential commentary with actual monetary policy. That is the one story that matters most today. Full breakdown is right here. If this kind of deep dive analysis helps you trade smarter, hit subscribe right now and tap the notification bell. We break down the stories that move markets every single day before the open.